Hey, welcome to People Think About It. Today, our special guest is Mr. Eddie, and we're going to talk about some financial things. We're going to talk about some stock market stuff. We're going to talk about us using money correctly. We're going to just talk and get into it. And we got our guest, Miss Aurdery. You know, she comes in, drops in from time to time. And we're just going to get this conversation started by saying that, we as a people, as a community, we try to reach out and, we want to learn how to invest our funds, how to become better stewards of our finances and everything. And then some of the things you're going to hear on the show today might help you out. So listen in and listen closely. And we're going to start off with some questions from Mr. Eddie. So, Mr. Eddie, we want to just know, how long have you been doing what you've been doing in the financial world?
Well, thanks for having me on the show. I have been trading ever since I learned about money, which was a long time ago. And essentially, I've been trading on the stock market about 15 years, 10 to 15 years. It was actually kind of passive, the usual 401k, the usual IRAs. Got introduced to it by my dad. We were talking earlier outside of the show, and he said how his company made some money on the side. So that's how long I've been investing. Started off with just CDs or certificates of deposit. Graduated to spending a little bit of my paycheck every month or every paycheck towards investing. And I didn't think much of it because it was very, very small amounts, $25, $35 here and there. And when it got to a significant size, that's when it began to interest me that how can I make this?
Right, so they're like compound interest. That's
Absolutely.
It got to a part. So one of the things that you just reached out and said, which a lot of people think you need a lot of money to invest, and you said you started off with $25 here, $100 there. So you don't actually need a lot of money to invest.
You do not need a whole lot of money. What you need is the mindset. It's not a math problem. It's 80% behavior and 20% math. So $25 out of your paycheck every so often, that's where you start. And before you know it, it's a lot of money.
Oh, okay. And when you start off like that, what kind of turnaround time should you look on? Because, most people, when you think about investing, they're looking about the turnaround. Yes. How fast is the turnaround? How patient should you be when you're in that kind of environment of the stock market or trading?
Well, to answer that question, you have to understand two terminologies. There is saving and there is investing. Most people confuse the two. Savings is money that you want to spend after some time.
Okay.
Maybe you're saving to buy a car, you're saving to put a down payment on a house, that's saving. Investing, on the other hand, is after you have done all of that, maybe after you're done saving, then you can do investing. And with investing, you need more time, at least 5 years.
5 years.
At least 5 years. So when we talk about saving, we're talking about short term, maybe 5-7 years. You have a specific goal. When you talk about investing, it's a longer term goal.
Okay.
Usually, it's with money that you brought out of your savings. Usually, it's for something like retirement. So you've got a long horizon. And then it also depends on which vehicle that you're using to do the investing. Most people will do it inside of their employer-sponsored retirement plan.
Right.
Some people would choose to do it on their own by opening a brokerage account, and I think that's great. That's where everybody needs to start. Right.
Okay.
First invest in your employer-sponsored account if you're working. If you're self-employed, then look into getting a brokerage account. These days, you can go open a brokerage account in about 20 minutes.
Okay. And how much does it usually cost to open a brokerage account if you're self-employed?
$0.00.
Okay.
That's where you start. Everybody has a minimum. Most brokerages have a minimum, but to open the account, it doesn't cost any money. They may have a minimum when it comes to the kind of securities that you can purchase. But that should not stop you from opening up the account. Don't wait until you have, say, $2,000 to trade inside of, say, a Vanguard account or something like that.
Okay.
There are so many instruments that only require you to have just a few $100s.
Okay.
So it's a discipline. Once again, it's the mindset that you're acquiring to start saving and investing as opposed to blowing this money away. And once you start seeing the results, then it makes a huge difference.
So investing takes a lot of discipline, you would say. You have to be patient and disciplined to be able to really get into that climate or that environment of investing. You have to have patience, more or less.
You do. In both cases of saving and investment, you do have to have discipline, because you're going without, you're living like no one else right now, so that later you can live like no one else. I'm quoting somebody else who said that.
Right.
But you also understand that when you're investing, there's the likelihood that you can lose money or you can make money. So you have to balance the risk.
Right.
Investment is when you decide that I've got this much money and I am willing to risk. So you have to use the positive words that you're willing to risk this much money in order for the potential gain, as opposed to you're willing to lose this. We're never willing to lose anything. I don't think anybody's willing to lose. So first change your mind and say, I'm not willing to lose this. I'm willing to risk this, and we want to make a reasonable risk given the trend. So what you have to do is educate yourself, start finding out what is a similar investment actually made, right, over the years.
Okay.
So if we take one of the benchmarks that everybody looks like, the S&P 500, over the last I don't know how many hundreds of years, but in its existence, it has done about 12% every year. It means that on some years it has been up 36%.
Right.
If you have been around since COVID, you know it has been down 27%. But over the last 25 to 50 years, it has averaged at least 12%. So when you're investing, you have to understand that it is for the long term, and you should not invest money that you need to use in about 3 years.
Oh, okay. I hear a lot of people, when they get into investing and stuff, and some people sit back and you just use percentages, and like you say, it's been down 27%. So, in I guess in thinking in a wise way, you say, well, if it's only been down 20%, it means it's been up 80%, right? Could you look at it from that perspective?
You could, but the last time the market was up 80%, I don't think it's been up 80%.
No, well, I guess what I'm saying is, if you're taking a certain stock and investing in it, and it was down 20%, is that means that 80% of the time that stock is doing well?
It is possible to look at it that way.
Yeah.
What you want to do when you're investing, you want to look at the track record of any security, and especially for the long term, you want to see what has its performance been over the last minimum 5 years.
Okay.
If the stock was just born last month or 6 months ago, for example, in the case of an IPO, initial public offer, it's a brand new company, it has no history. So you want to invest in companies that are well known from things that you use every day, and that they have a long track record, and you can see that over the last 5 to 10 years, this is how it has performed. And so that gives you that expectation or that timeline that if I buy this today, and if history were to repeat itself, which it mostly does,
right,
then the trend would be upwards.
Okay.
You also notice that it doesn't happen overnight. So if you're investing and you're looking for your money tomorrow, then you're going to be looking for quite a bit. I don't think you're going to find it.
Right. So let me ask you this question. How old or how young should a person be before they start investing?
I'll tell you what, my kids right now are still in high school and college. Every one of them, and I have 3 kids, have an investment account. The youngest is 15.
And how early in life did you teach them about investing?
The 15-year-old just started. She's about a year into it.
Okay.
And they're not eligible to open their own account. So they have to be under their parent or a guardian account. So it's called a UTM, or Uniform Transfer to Minor account. So you can go to any brokerage, they're going to ask you a bunch of questions, and you can open it under your own account. You have to have a parent or an adult be the primary, and then they would have their own account. What happens once they reach 18, depending on the brokerage, I think it's 18 or 21.
Okay.
And once they reach that age, then they get more privileges in that account. You now turn it over to them, and it becomes theirs.
Oh, okay. So they have to be at least 18 to 21 to deal with a broker, basically.
By themselves.
By themselves.
Yes.
Unless they have a adult, or custodian parent that's willing to, sign for them, right?
Absolutely. And the good thing with those kind of accounts is that with most or all brokerage accounts, they have what they call trading privileges, meaning that you cannot just trade any risky trade. They have a set of privileges that they give to those minor accounts, if you will, and that allows some controls to be put in place. I'll give you an example. We know that somewhat risky trades like selling options is a risky event. You've got an unlimited amount of risk. They will not let that happen inside of a child's account.
Okay.
Instead, they will let them be able to trade simple things like buying shares, maybe buying calls, buying puts, and in fact, they might not even be able to trade any leverage. They might not have any margin. So margin is where the broker will let you spend more money that you have inside of your account to buy shares. That's very common.
So how do you know whether or not that's a child's account? How do you know that? So even though I may open up an account in my child's name and I want to do the things that you just said, how does one know that that's actually a child's account? Because I feel like there's some room for some fraud there.
There is. Well, every one of us has a social security, and you do have to first open your account before you open a child's account. So there's your social security, and they will verify that. They will also verify the social security and the identity of your child.
Okay.
So there's this law, and I don't remember what it's called, but it is one of those, just like when you go open an account, they want to know who they're dealing with, who they're working with.
Right. They do that with the banks as well, too.
Absolutely. And most brokerage is actually tied to a bank. They have a banking or they have something that holds the uninvested money or something like that. So they're under the same regulations. They're very, very, very well, tightly regulated industry.
So you need to have a broker to be able to trade?
You just need a brokerage account. It's called a brokerage account.
Okay.
You don't need another human to help you out.
Well,
okay. You can get an advisor, and those are different kinds of accounts called managed accounts. But if you want a self-directed brokerage account, those you can get every day.
Like TD Ameritrade, Charles Schwab, and things like that.
Absolutely, those are very good companies. There's TD Ameritrade, like you said, Schwab, Fidelity, E-Trade, any of those. Even Robinhood, if you want to start there, that's for the small, retail investors. A lot of students do that just to keep their money in there and trade a few shares every once in a while. That's the beginning.
So go ahead, Audrey.
I was just going to say, so when you think about trading and you go to like a TD, what is it?
TD Ameritrade, which Charles Schwab took them over.
Yes.
TD Ameritrade. Can you still make the same amount of money if you manage your own account versus having a managed account by someone else?
Well, that's relative. So the statistics indicate that managed accounts actually make more money than self-managed. And it all comes down to trading psychology. When you're trading by yourself and managing your brokerage account, if that's not something that you were taught or you do in your professional life, then obviously you're not going to do as well as somebody who was well trained, has gone through several certifications in order to do that. Additionally, when you do a self-brokerage or when you trade yourself, you're subject to your own emotions. As humans, we will tend to panic and sell when the market is going down and what side of the sky is falling, Whereas in a managed account, they have several things that you do not have. They have the power of leverage. They also have knowledge that you do not have. They probably have better tools, and they have rules that they can follow. For instance, they are under the obligation as fiduciaries to make sure that they are acting in your best interest, meaning that if they understand that the market is going to be negative and that your account may suffer as a result, they may want to advise you. Remember, the decision is always yours, so they may want to advise you to take some action on the account, and they will do it on your behalf in order to protect you, or they might guide you into different strategies. So for that reason, I think on the longer term, managed accounts tend to do much better.
Yeah, I was going to ask you that because I've been hearing that a lot about fiduciaries. Could you explain what a fiduciary or the people that handle fiduciary, what do they exactly do versus someone that handles regular investment accounts?
Fiduciary, by just the basic meaning, is that they are acting in your best interest, and that's what you're paying them to do. They have to do that in your best interest. It means that they are not swayed by the amount of commissions that they get paid. They do get paid. They have to get paid to do their work, but they are not doing it for their own benefit.
So they're more or less in it for the consumer's benefit.
Absolutely, it's got to be for the consumer, and that's by law, and also just good practice.
Okay.
There are I'm going to flip to the business side of this. There are a lot of people who have started out in the options trading, day trading space. I think a lot of them was intrigued by Wolf of Wall Street and Boilerplate and The Big Short, things like that. It looked sexy, but you saw some really bad things happen there. And so when we were exposed to it, I was exposed to it through some of those things. Everybody got excited about it. They wanted to get into it, and then people started to lose money. Now, you are a full-time trader. What does that entail? Because I know there are going to be people who are going to listen to this, and they said, you know what? I want to do that. I want to be able to make some passive, which I don't think is passive at all. It could be, I guess. I want to make passive income. I want to be able to trade stocks and all these things. Share a little bit about the business side of this whole thing.
Good question. So options trading is trading by any other name. You're simply buying low and selling high, or selling high and buying low. The difference with regular trading is that this is leveraged. So when you are doing options trading, you're actually trading instruments called options, and they represent shares. For example, one options contract actually represents 100 shares. Just to give you an example, say you wanted to buy Apple today. Apple is costing maybe 184, give or take, and that's just one share. If you wanted to buy 100 of them, you would need about 18,000, give or take. Whereas if you wanted to buy an options contract, that would roughly cost you, and I'm just going to pull up over here, it would cost you maybe about $1,000, give or take, and that would represent 100 shares. So you can see the difference here, that you're spending $1,000 to buy one contract of Apple, which represents 100 shares, and it means that in order for that contract to make you $100, Apple just needs to move up around $1.
Okay.
$1 or $2.
So you're spending $1,000 you spend that $1,000 to make 100 shares to buy, like you buy, instead of going to Apple and spending $18,000 to buy 100 shares. Okay.
So why don't more people do that? Sounds.
It's very risky. It's risky, and you have to have the knowledge to do that. You have to understand how that works, and just to correct that.
And that's called option trading.
That's options trading. Yes.
Okay.
So you're actually trading the options contracts.
So let's talk about. Like you say, it has to go up about $1 in order for you to make $100. So you make like a 10% return on your $1,000.
It could be, yes.
Yeah. So if it goes down $1, then what happens?
You're losing that 100 or 200.
You're losing, so you don't lose your whole 1,000.
You can lose your whole 1,000.
Oh, okay.
And here's the kicker to it. Because it's leveraged, it means that you make money faster. But on the downside, you also you also lose money faster. And let's understand the difference between the two things. The shares is something that you can hold. It's it's a store of wealth. I can hold it for maybe 5 years, 10 years, whatever. I can transfer that as wealth. I can give that to my children. I can give that to my neighbor if I wanted to. Options, on the other hand, have an expiration date. So if, for example, I buy a 14-day to expiration contract, it means that at 14 days, it must go down to zero. It will be worthless. That's called expiring worthless. So it can be worth something or be worth zero. So that 1,000, the thesis here would be that the price of Apple, which is what we call the underlying, is what would be going up. So that we would build a plan saying that we think that Apple is going to go up. And so for that reason, I'm going to buy this contract that represents 100 shares. And if it does go up, then my options contract will increase in value.
Now, can you, like I heard you say, like you could have an option contract for like 14 days or what have you. Can you at any time say, well, I don't want to go the whole 14 days and expire that contract?
Absolutely, absolutely. So even if you buy 14 days to expiration or 45 to 90 days in expiration, it does not mean that you have to hold the contract for that many days. The reason that you would want to buy a longer dated contract, for example, for 45 days, is for your thesis to work out. You don't know whether Apple is going to go up today, tomorrow, next week, so you need to buy some time.
Right.
And any time between now and the time that the contract expires, you can achieve your objective. Or you can decide that this is not working for me. Basically, the price of what I bought is actually going down instead of up. And so you can cut your losses very quickly.
Oh, okay.
So you're not tied to holding that. And there's a difference. And that's called swing trading.
Okay.
Swing, as opposed to I want to buy the contract today, and it does its thing. It either goes up or it goes down, and then I sell it before the end of the day. That would be called day trading.
Okay. So, in making those statements, could you give us a little bit about the words or the terminology that most people will hear on a consistent basis when they're trading?
Yes, so the most common terms are buy and sell. So when you're buying, for example, if you're buying shares, you're simply buying a piece of or a certificate that says that I own a piece of, and we're going to go here with the Apple example here, and say that I own a piece of Apple. Apple is a $3.3 trillion company. That's it. That's its market cap, and I'm owning a piece of it.
Okay.
Right. And when you buy the contract, then you're referring to the instrument that represents the shares. So you can see that there's somewhat of a ladder. You start with the shares, then you're going on to the contract. But there's a buy event and there's a sell event. You, as the trader, are the one who's buying. And it's not something you take home with you. It's just electronic.
Right.
Right? And so you can also sell it. So you're doing both the buying and the selling.
Okay.
And there are instances where you can get into even more advanced trading where you're even selling something you do not own, and that's called shorting.
Okay.
So there are many nuances to going all of that. But some of the more common terms that you need to know are buy, sell, contract, shares. You need to know which kind of brokerage you want. You need to know what kind of account you want. You need to know the difference between margin versus a cash account. For example, when we hear of margin account, we think that somebody's giving us money to trade. Well, they are giving us money to trade, but we also have to have our own skin in the game. And there are minimums that you have to meet. For example, for a margin account, the minimum you have to have in your account is $2,000 for such an account. But it doesn't mean that you have to have $2,000 to get a brokerage account. You can start a cash account, a brokerage account with maybe just $500.
Oh, okay.
And that will allow you to do a lot of things that you can do with margin. Not everything, but it will allow you to do some of the most basic things. And can you make money in either one? The answer is yes.
So it sounds, some of this stuff sounds really complicating, and I guess it takes, like you say, time and years and education. And just starting out for someone that wanted to, get into this business, where would you start them at? Where would their starting point be? What would you advise them of their starting point?
Well, education is always the most. That's the starting point for everything. You have to ask questions, ask a lot of questions, and many times we don't know what to ask. So I have a school that I teach options, and that's all we do, from fundamentals all the way to advanced trading. The objective being to making weekly income, consistent weekly income. But you do have to understand the fundamentals. The good thing is that you don't have to get out of the gate running, get into the stock market with real money. There are simulated accounts, and we teach on a simulated account before we progress onto a live account. A live account meaning that you've got money in there that you pull from your bank and you put into the brokerage. Simulated meaning that it's a demo account.
Okay.
Start you off with somewhere between $30,000 and $100,000, and let's trade that. Let's learn how to trade that. Let's learn how to multiply that.
Okay. So do you need any kind of certificates or degrees or licenses to be able to teach this stock trading?
To be able to teach it, no, I do not have to have. I don't have to be certified to do that. But for the student, what they need to get into the game, they just need your standard business tools. Most people should have a good laptop.
Okay.
Right? Or they should have a good smartphone because it has to have the capability to have an app. For example, the Thinkorswim app or the E-Trade app or something like that. And then they have to have internet. That's priority. You have to have good internet. Good internet. I would suggest for most people who will learn how to do it, they should do it on a laptop or a MacBook or something like that before they do it on a smart device.
Okay.
The reason is that the features that you have on the full desktop version of most of these apps will allow you to even learn. They have tools inside of them that will help you along the way. When you go over to your mobile device, it's a scaled down version, and it's intended really just for quick actions. Something like you want to check the balance, you want to rebalance a trade, you want to get out of a position, you want to set an alert on something, on a price maybe. Once it reaches a certain price point, you want to be able to do something, and so on and so forth. So most people, I believe, have got the tools: fast internet and either a laptop or mobile device. And then the other thing is just a brokerage account. For as long as you're eligible to open a bank account, I believe you should be eligible to open a brokerage account.
So when someone takes your class, how long is the class, and how long does it take for them to actually see that, now I'm ready to trade and make some money? So
there's not one
in real life.
Not everybody's the same, but my class, I've got two versions. I've got, and they're both 8 sessions. 8 sessions over a period of 4 weeks, which means 2 times a week for 8, or 1 session a week for a total of 8, and that goes over for, I guess, 8 weeks.
And what kind of time do they have to invest?
They have to invest at least 1 hour on each session in the class, which I teach live. Live meaning that it's on a Zoom call, you're talking back and forth, there's questions, there's demo, there's examples, there's actual content, new material being provided, plus how to do it, and presentations as well. Outside of class, I expect students to have maybe another 2 hours of study time. And that's very, very important because they have to study the material that they learned in class, and then they also have to dedicate maybe 30-40 minutes in the live market.
How much is the class?
The class is actually $3,500, and that's a one-time cost, and it includes all of that.
Okay.
So just to clarify that, on the practice side, when they're practicing during the live market, the market is only open 9:30 to 4 o'clock Eastern time. And so they have to have some time during that part of the day to practice maybe the lessons.
So would you recommend them to stay in front of that computer the whole time the market is going, or you recommend that, hey, what I've taught you, at least study that market for an hour or so you kind of get the concept and the idea of what's going on?
So, no, they don't have to be in front of the market the whole day. That's too much time. They can do this on their own in the evening on their simulated account. So the simulated account also has the same features as though the market is open. You can go into an on-demand feature and simulate how the market looked like on a particular day. Right? So you can do that if you do not have time during the day. If you have time during the day, then I would suggest that you still study this outside of the market and then spend maybe 30 minutes to an hour at least once or twice a week.
And we had a conversation earlier before we got online, and Aurdery came up with a good point that you get people that sit back and want to be involved in your class or want to learn how to trade and things like that, but they're not willing to put in the time. So whatever cost they may be to it or whatever, and then how does that reflect back on you when they come to you? Well, this is not working. Do you instantly know, or do you know that they're not doing something that you taught them or something that you recommended as far as study time?
Oh, yeah, sure. I get to know my students very well. My classes are actually 10 students max per class. So I have several classes going, and so I get to know each student very, very well because it's necessary to have that one-on-one relationship. I already know that the students who ask a lot of questions are actually doing something.
Okay.
Because a lot of this is very, very hands-on, and you would not even know what kind of questions to ask if you'd never even tried one time. So it's very involved. Again, my class is results-based. I want to see results. They have homework that I give them. You don't have to turn in your homework, but they know to do the homework.
Okay.
Yeah.
That's a good question. So, the stock market is always so fickle. We don't know when it's going to go up. We don't know when it's going to go down. And I know I've talked to people before who've said, you know what, you got to have a stomach for this. You got to have, you got to be able to stomach the risk. You got to be able to stomach the fail. What do you say to those people who say, I want to get in, I want to make a lot right now, and then I want to get out? What do you say to that person? Because I know you talk to those.
Right. So I think that you may or may not need a stomach for it. I don't know about that. What you do need for sure is good heart medication. So maybe I'm just describing myself.
Right.
Just describing myself. But this is a problem where it is 80% of behavior and 20% math. So if you can do the math and you can control the behavior, then you have a better chance. And it's also about risk management. So I can teach you how to make the money, but if you don't know how to keep that money, then that's a problem.
So you can't make it and go out and be spending, have bad spending habits.
Well, if you're spending it, that's a good thing. It means you took the money out of the market, right?
Well, I'm saying as far as managing it to the point of I'm showing you how to make it, but now you constantly always got to stay because you're spending it as fast as you're making it.
The risk here is that you're giving it back to the market. A good example here is that say your stock goes up and then you don't take that money, you don't sell that position or close the position, and then it goes down. That's bad risk management. Or you start out flat and your thesis doesn't work out very well, and instead your stock value goes down or your position goes down, and instead of identifying what the cutoff point is and respecting it, it's called a stop loss, by the way. Instead of having a good and stop loss and actually respecting it, then that's bad risk management. So one of the things that I teach is once you get into a position, you need to know two things. Actually, you need to know three things up front. The first thing is where you're going to enter the trade. The second thing you need to know is what your take profit is, because you should have calculated what that potential is. And the third thing is what is your risk level. You're answering the question, if this position goes down by, for example, $100, what am I going to do? Am I just going to sit over there and hope about it? That's a bad strategy. That's called hopium. I don't think they don't have a vaccine for it yet. So we don't want to work on hope. Instead, we want to work on objective math that says that if the position has lost X amount of dollars, then it is no longer viable.
Right.
We need to close that position. That's the part of risk management that We have to understand them, up front.
So the question I have is this: is that we talked earlier about schooling and education, what they don't teach in them. How hard would it be for someone to want to do this and they're not good at math? How hard would it be for them to do this?
So the good thing is that you don't have to do the math by yourself. The software is very, very good these days. The brokerage platform actually gives you tools to be able to look at your potential profit and your maximum loss potential. So you've got all the tools. What you have to now be able to do is to read and interpret what it's saying, build some simple rules around it, and respect them. So you don't have to be really good at math. You don't have to be a math wizard or have a fancy calculator to be able to calculate, big options position. You just have to, understand the rules and go by that.
I got a quick question for you. Is it realistic or unrealistic to think that you could start out with a $300 investment account and turn that into $1 million in 12 months?
That's unrealistic.
Okay.
Yeah. $300 to $1 million is very, very unrealistic, and there are conditions, of course, where that could happen, but I don't think in real life that would happen. So many things would have to line up.
Right. The whole world would have to line up.
Yes, something.
Well, I heard you say that you did it for your kids. So, do you have to put the money in every month, or do you have, or do you just put a certain amount in there and just watch it?
Well, I put in amount in $1,000 for each of them, and I said, go ahead and grow it, and I showed them how to do that. Mm-hmm. And they can grow that just to 1,000, and it will continue to grow for as long as they're trading, or they can also add money to it. For example, when one of them got a job, she dedicated, I don't know how much she dedicated per paycheck, and it just grows. And she's investing, she's continuously investing. So that's a good habit.
Now, is she investing in options or is she investing in the regular stock market?
Because of her type of account, it is just shares.
Shares, okay.
She's not eligible to do options just yet.
So what do you think about, we know that you have a platform on YouTube, you have the Instagram, and what do you think when you see now all these guys that's on like these platforms, Instagram and TikTok and everything, and they're talking about investing and trying to get people investing. Do you think that it hurts people mindset or thought process, because now all of a sudden it's this swing of everybody talking about it, doing it, or just like everybody's talking about they get on these Instagram, Facebook and stuff, let me show you how to do an LLC. And a lot of times I explain to people, they can show you how to do this, but then they don't tell you what the back end is. Because if you go open up an LLC and go to this bank and get $10,000, you go to this bank and get $50,000, and they tell you, next thing you know, you got $250,000. But the minute that you use one penny of it, you got to start paying it back. They're not telling them that part. So when you have all these people on social media talking about investing, and we have you here today sharing with us some of the terminologies, some of the good, bad, or in between. Just like you say, you need heart medicine. They're not telling these people all this stuff. So give us a little feedback on that.
I think that information is more available now, today, than it was a long time ago. So let's take an example of YouTube University. Let's call it YouTube University. Mm-hmm. If you want to assemble this table, just go ahead and Google on YouTube how to do this particular table. It will show you step by step. That's the easy part of it. When it comes to investing, this is a very complex subject, and you can learn a lot from YouTube or Udemy or other platforms. What you really need, if you're serious, you need to get into a good program that is results-based, that has a track record, and that's the missing part of it.
Right.
I pride my course myself in the course that I teach because I go into excruciating detail inside of the class. Even though the class is supposed to be 1 hour, many times we go well over 1 hour, like an hour 15, an hour 30 minutes, and we do several. So I talk from experience.
Okay.
I teach from experience, and that's very important. You need a teacher who is able to convey some of these complex descriptions or explanations very, very simply, and I should be able to ask you a question and you can explain back to me what we just did or the rationale of why we should pick a particular position or how to trade a particular trade.
Right, because I know, like I say, with the social media thing, you know, you have people on there and they say, I can teach you how to invest, I can teach you how to trade. Then you go further down, it's buy my program, you know, click on this and get involved in a program. Then they tell you a little bit, then you need to buy this, you need to buy that. And next thing you know, you can spend $3,000-$4,000 and still you at point A.
Yeah, and that's very important. You know, I pre-qualify my students, and I tell them, if this is the money that you have earmarked for your mortgage payment, for your rent payment, for the food on the table, this is a good time to stop. Don't pay me. Don't put this money in the market. You're going to lose it because you don't know how to take care of it. This is a very, very touchy thing. It's very risky. There's plenty of risk to it. Investing has got risk. It's not the same as savings. So remember, we talked about savings. Investing has risk. So if this is especially money that is out of your family budget, it should not be used in the stock market.
Okay.
That is currently. So what I tell my students is, go save some money, and then even before you spend a penny of that, let's go through the class. Let us go through a simulated account and see what the potential could be. Learn how to do it, and I teach them how to make $100, and then the next thing is your homework is to go put a zero behind that before the decimal point.
Oh, okay, that's good.
Let just when you open a business, you have your business plan, you have your market, your funnel, and all that. You go into excruciating detail to determine how your business is going to make money. This is a business.
Mm-hmm.
Right.
So we have to understand, how am I going to make my first $100? Let's learn how to do that.
Right.
And then once you learn how to make that $100, let's go ahead and multiply that 100 and see how we can scale and understand that it's a matter of time, not necessarily skill.
Okay. Well, we want to thank you, Mr. Eddie, for coming on today. We want you to share with the people what platforms they can go on to get some information on you and share things. Share your platforms.
Oh, absolutely. The way to find me is on the internet at Options with Eddie. You can go to optionswitheddie.com, all in one word, and that's where the link is to all my social media. You can find me on Facebook at Options with Eddie. You can find me on YouTube as well, just by Googling me. But the main point where you want to go to is optionswitheddie.com.
Optionswitheddie.com.
And you don't owe him anything.
And you don't owe him anything. But you will learn a lot of things. So we want to thank you once again, Mr. Eddie, for coming on the People Think About It platform and sharing with us, because I think that we have to take these kind of platforms and really educate people about finance. It's not all about spending. It's about accumulation. And I like the one thing that you said, you have to define, this is my savings, this is my investment, to separate the two, because most of us that's uneducated about it, we take and combine the two. And then when we got that zero in the wrong place, we want to point fingers and blame others. So we want to thank you once again for coming on to People Think About It. And y'all can reach out to us at peoplethinkaboutit.com. You can email us at peoplethinkaboutit@gmail.com. Check out our platform on our pod page at peoplethinkaboutit.com. And once again, we want to thank Miss Aurdery, Mr. Eddie, and my wife Dorshell for being here. And hopefully you guys will get educated, finance, and look up. And we want to thank you again for listening to People Think About It.